If you've got $500,000 of your own money in a live personal trading account, and when you lose $5,000, $10,000, that's going to hurt. No matter the percentage movement, the reality is that's your hard-earned money and you're risking your real livelihood. So you have to be professional and you have to be careful. But we are in a unique time in the trading space. We have access to so much good content online. We have access to so much information. And lastly, we have access to capital. And capital changes it all. As you've seen on my podcast Titans of Tomorrow, where I've interviewed some of the biggest traders in the industry, a lot of them have said trading is a game of skill, of course, but more so it's a game of capital. Now think about it, if you have a $1,000 trading account and you make 50% gain, from a percentage perspective, you beat the markets, you beat the odds, that is phenomenal gains. However, if you made that 50% gain on a $1,000 account, well, you're probably better off still working at McDonald's and earning a minimum wage salary. So if you have equal skill sets, the differentiator between someone who makes a lot of money and someone who just gets by is capital. We are in a unique situation where we have a lot of potential power with prop firms as long as we play to their rules. However, this is where the opportunity lies, because we can play to their rules, sure, but we can also take advantage of their rules. So in this video, I'm going to give you a step-by-step guide on how you can maximize your profit taking from prop firms. And no, I'm not talking about just simply getting $1 million in funding and trading that slowly and asking for a payout once a month. That's the normal way, that's the boring way, that's the way they want you to do it, and that's not the way you're going to make the most money possible. So I'm going to give scenarios on how you can optimize profit taking from prop firms whilst not even being the best trader. For example, you can be a break-even trader. Heck, you can even be a losing trader. So long as you have winning periods, you can make payouts from the market and actually overall be a positive trader because of prop firms. But if you had that same situation on live accounts, you would be in trouble. So that is the power of prop firms, and this is how you hijack the prop firm industry. Now, we can do this from 4 perspectives. Number 1 is you are a break-even trader. So overall, at the end of the month, you're basically up 0.5%, 1%. You just haven't quite got the edge in the market to be long-term profitable, but you can pick some winning trades, make some high risk reward and make some profit short-term, but long-term you do struggle. Well, you can still make a lot of money with prop firms, and I'll show you how. The other perspective is you are a losing trader. So at the end of 2 months, 3 months, 5 months, you are down -3, -5, maybe even -10%. So you're not a good trader at all, and you need to address a lot of things, especially if you want to take this seriously, especially if you're going to make this your life. You need to study a lot, test a lot, optimize everything for data, and find primary drivers, and basically watch this channel because I've made so many resources on how to become profitable. And in fact, there's been a lot of profitable traders just from watching this channel. In fact, Hamza, a young man from Morocco who's just been following my signals, following this YouTube channel and been putting in the work, taking action, testing each one of my public signals, he at the age of 17 made $10,000 in withdrawals. And he is not the only one. There's been countless people funded just from this YouTube channel. But nonetheless, even if you're a losing trader, maybe you can still make a few $1,000s with prop firms and still be a losing trader. Third is you are a profitable trader. You have an edge in the market. You're consistent, you're dedicated, and you have a healthy equity curve that is linear and slowly growing over time, maybe 1, 2, 3% per month. But that's exactly what you need to make money. Now, here's a hack so you can make even more money on this type of equity curve as opposed to just 2% per month. The last one, category 4, is my style of trading. And if you've been watching my documentation of my live public signals, just for reference, I've been doing it for over 7 months now, where I give every single one of my trades live ahead of time to the public for free, full explanation, full documentation, as publicly transparent as anyone can be in the industry, because no one can fake live callouts. So if you've been watching that 7-month project so far, at the time of filming, I've gained about 56% gain total. You will see my equity curve has been growing, but it's not been growing in a steady fashion. It's been growing slowly at the beginning, positive, and of course I have my losing periods, but the goal in the beginning is to build my buffer. So when I was building my buffer, I only had my A+ setups, my highest win rate, highest quality prime setups. Once I had built my profitability buffer, then I started to introduce my A setups, my B+ setups, my C+ setups, with the idea being I slowly lower my win rate in a controlled fashion. So it's no longer 75%, but I bring it down to 50%. Once my win rate is at 50%, my trade frequency comes up because I'm taking B+ setups and C+ setups. So when I bring my win rate down, my trade frequency up, and my risk reward profile is solid, I know that I can overall increase my rate of return, my equity curve growth, in a faster fashion. So I went from slow linear to faster compounding growth, and that's how I went from +20% to +50%. But also the power in my gains is the fact that because I have a fixed TP protocol system, at 1 to 3 risk reward, I will lock in 50% of my position size, therefore securing 1.5% gain. And at my final TP, which is a 1 to 10 risk reward, I lock in the remaining 50% of my position size, therefore locking in 5% gain. So 1.5 plus 5 equals 6.5% gain on my final TP winning trades. So when you notice my equity curve, I have my wins, I have my losses, but overall I'm growing slowly, 1.5 hour, 1.5 hour, losing trade, -1, plus 1.5, and so forth and so forth. And then I get a full win, 6.5% jump. So that is a significant jump in equity curve. It kind of goes slow growth, jump. Slow growth, maybe a loss, jump. And that staircase fashion is so powerful in a prop firm scenario because you just got to time your account and time your payouts to make sure you really compound on gains on a short-term horizon because of a large win. So the key to prop firms and playing to the rules, playing to the system is all in basically how you take profits, how you manage your accounts to optimize for profitability. So the boring one is you start all of your accounts on Monday, the 1st of the month, and you trade them all to the end of the month, and at the end of the month you take a withdrawal. Whatever your end result of the month may be. So if you're the losing trader, well, you didn't make profit. If you're the winning trader, okay, you made a few percent gain. If you're a break-even trader, okay, you made 1% maybe. So depending on what kind of a trader you are is how much profit you'll make from prop firms. And that's the mistake people made, because that's what you should do on a personal account. But on a prop firm account, essentially you gamify the whole situation because it's not your money. There's a reset button, and if they put rules in place, you might as well maximize to their rules and make as much money as possible because they're preying on your downfall with their suspicious rules. So basically we have two profitable methods that we can take. Number one is the 2% rule. So for the sake of this video, and just for example, let's say you have $1 million in funding. Very achievable. I know so many people that have it. I even have members within my 6-month consulting mastermind that have $1 million in funding. So I want to put that out there to say it's a very achievable standard that many people are doing. And the 2% rule is basically capping your upside, which seems like a limitation, but it's basically to secure a payout. So even if you have a losing period after, well, you actualize the payout. So no matter the health of your equity curve, no matter the health of an exact prop firm account, even if you're having a losing period, the moment you have plus 2%, even if you had a massive losing period, slowly climb back 2% gain, you locked in money. Even if your equity curve is trash, even if you maybe lost a couple of accounts along the way, you still made real money. And the reality is it doesn't matter about your P&L. It doesn't matter about your equity curve. It matters about what the money in your bank account is. Let's say you paid $500 for a prop firm account, but then you lock in a 2% payout on a 100k account, and then you got the refund because of your payout. Well, your risk to reward is basically $500 in, and you made maybe 2 or 2.5k. So you made a positive risk reward, and that's what counts. Maybe you blow some accounts on the way. Maybe you lose some funding along the way. Maybe this whole prop firm process, you spend $5,000 or $10,000. But if you're consistently locking in 2% gain, $2,000, $2,000, $2,000, these will really add up, especially if you have $1 million in funding and you have 10 100k accounts. It's very easy for you to scale to 10, 20, 50k in payouts, but in small 2k increments. So it's going to be the slow way, but it's a reliable way, and it doesn't require you to be a phenomenal trader. Even if you're that losing trader, the moment you have a winning period, even if you're in an overall downtrend in your equity curve, the moment you have a winning period and plus 2% on an account, you lock in a payout, maybe you lose some accounts. So you have to test the overall risk reward, and it might not be the most profitable approach if you have a losing equity curve. But if you're one of those break-even traders or even a slow profitable trader, the moment you hit these 2% milestones, you lock in your payouts, your bank account is slowly going to be growing, and your equity curve should be rather stable. So this is the sensible approach, and this is the approach I would recommend until you've made at least $10,000 in payouts, because your goal in the beginning, once you are funded and once you have $1 million in funding, is the recuperation of all of your expenses, all of the education you've paid for. Maybe you've paid for some rubbish mentors, maybe you've had some good education. Well, there's a cost associated there. Number two is the cost of all of the evaluations, even the failed accounts. You have to factor that in. And then obviously when you pass accounts and then you make a withdrawal, you get refunded your initial fee for the evaluation. So basically you want to make sure you are break even on all of these costs: cost of funding, cost of gaining capital, cost of blown accounts, and cost of education. Now once you have achieved a full break even on all your expenses, that's when I recommend you go to my system 2. Now this is a system that I've developed, and I like to call it the revolving door method. And you're going to be utilizing the revolving door method exclusively on prop firms, with the idea being your goal is to make a lot of money in a short amount of time and take that profit not to fund your lifestyle, not to buy a Lamborghini, but to put it into a personal account and then trade that personal account as soon as possible and get away from prop firms as soon as you can, because prop firms will ingrain bad habits. It will naturally ingrain a short-term mentality. It will naturally ingrain a gambler's mindset. These are not healthy for a long-term professional trader. And if you're going to be doing this for more than a decade and want to make a full career out of it, you have to be careful of your subconscious wiring, and you have to be careful to not build these bad habits and not get too acclimatized to the prop firm industry, because it is not reality. And to be honest, with regulations and prop firms collapsing all the time, we don't know how long this opportunity is really going to last. Now, this obviously requires you also to have a bit of money. This also requires you to be able to get funded to $1 million, therefore be able to invest in yourself. Therefore, I also say you need to have a job or a stable income or something to support you so that you can afford to pay for these challenges and not be desperate for a payout. Because as we know, at the moment you have desperation, that is the worst anchor for a trader, because that's when you trade with emotions, that's where you trade erratically, and you'll never make any progress. So if you have money problems, go solve them outside of the markets first, and then bring stability and emotional regulation into the markets, including prop firms. So visualize this with me. The revolving door strategy is not the idea that you have 10 100k accounts, your total $1 million in funding. You're not going to start all of those accounts and trade all of them from the first trade of the month. And therefore, if you made 2% gain, you would have made $20,000 across your 10 funded accounts of $1 million in total. Now, that's great on a short-term horizon, but what if you have a losing period? What if you have a winning period and then a significant losing period? Depends on how your equity curve is, and especially if you're a break-even trader or a losing trader, you don't want to start off and have a huge hole in your equity curve and be in drawdown across all of your funding. So the revolving door will solve you of any pressure that comes from performance anxiety. As we know, prop firm statistics show that majority of people don't even get funded, but those traders that do get funded, majority of them lose their funded account within a month. And those that make it to payout number 2 are so small that certain firms that have over 50,000 traders that are funded will only have 2 or 3 people that make it to payout 2. It is so rare, and the odds are totally against you, and we have to be aware and recognize that performance anxiety is a real thing. Shiny object syndrome is a real thing. Chasing the big numbers is a real thing, and especially when people are not used to big numbers, it's very normal to see $1 million in funding. I could make 200k if I just make 20%, and I made 10% before because I got funded previously. So you start to do all the numbers, you chase the high, you chase the gold, you chase the big returns, and then you lose all of your accounts. A common story. So the revolving door is a little bit more long-term thinking. It avoids the performance anxiety, and the way you're going to do it is, instead of starting all of your accounts at once, you start it with a staggered approach, a revolving door strategy. So you don't put all of your eggs in one basket, and not all pressure rides on one account. Rather, each account is basically not that important, because you're looking at your overall payouts. You're not even so concerned with your overall equity curve, because not all of your trades will be placed on all of your accounts. Now that might seem quite counterintuitive, because you might have a big winning trade, you make 3-4% gain in a single trade, so you could have made 30-40k if you have $1 million in funding, but instead I'm saying don't put it on all the accounts, so you might only make 10 or 15k. Well, yes, you do have an opportunity cost there, but also the losses are going to be less. But it's not about that. It's about diversification. It's about diversifying your portfolio basically, and not having full exposure, because we want to minimize our risk and lock in as many payouts as we can. So what you're going to do is start your accounts with a staggered approach. So let's say on Monday you start account 1, on Wednesday you start account 2, and the following Monday you start account 3, following Wednesday account 4, and so forth. So of the 10 100k accounts, it will take you 5 weeks to actually deploy all of them, going on a Monday and Wednesday rotation, and then you'll also have an off period. So once you have all 10 accounts live, the following Monday you're going to deactivate account 1 and you're going to take a 2-week break. And then the following Wednesday you're going to take a 2-week break on account 2, and then on the following Monday you're going to take a 2-week break on account 3, and you start to see the pattern. So you're going to have a process where account 1 is active for 5 weeks and then off for 2 weeks, and then again active for 5 weeks and then off for 2 weeks. And account 2 the same, on for 5, off for 2, on for 5. But you're noticing it's going to be staggered, where they don't start at the same point. So when you look down your list of 10 accounts, you will start to see there's periods where only a few accounts are active, and you're going to have certain periods where more accounts are active. But the reality is your equity curve is not going to be allocated to all of these accounts at once. You're basically trying to revolve your accounts in a way that your losing periods and winning periods are not so heavily influenced on your whole portfolio. Rather, they are scattered and distributed across. And that's why I call it the revolving door strategy, because you're always going to have accounts coming in and out, with the whole idea being we are diversifying our risk, we are trading aggressively, and we are locking in payouts left, right, and center. Now, instead of capping our payouts and therefore capping our potential on a 2% rule as we previously spoke about, rather we are going to be doing payouts on a bi-weekly basis, meaning to say on Friday at the end of a 2-week period, whatever payouts we can secure on whatever accounts are active at that time, we lock them in. So we are going to be constantly securing on Fridays bi-weekly, we're going to be securing payouts. So that means it doesn't matter your overall portfolio growth, it matters how much money you have at a certain point in your account. Now, there's nothing special about that Friday. It's just an arbitrary date, but it's more to say when you have distributed your risk and distributed your trades over 10 accounts in a revolving fashion, this is what you need to visualize. So let's say you're that trader that's a consolidating trader. At the end of 10 weeks where you've had accounts on and off, and certain periods where you only had 2 or 3 accounts active, other periods where you've had all 10 accounts active, maybe you only gained 1% after 10 weeks. So in that sense, you would have only made $10,000. But with the staggered approach, and obviously with time, this becomes more and more profitable. But let's say 10 weeks for now. Let's say you had within that consolidative equity curve, maybe you had a period that was plus 7%. And then you had a losing period that brought you down to minus 4%. And from that minus 4%, you climbed up to plus 5% and then back down to 2% and so forth. So even though you've been having a choppy equity curve, you have your winning trades, you have your losing periods, you're still kind of solidifying your edge. Maybe your emotionality gets the best of you. Maybe you start to revenge trade. Maybe you start to overtrade. So there's still things you need to work on. But the point is more this. You had periods where you went from -2 to +5. So if you timed it in a way that, okay, you had your losing periods, your break-even periods, but you timed your payout on the revolving accounts, maybe you caught a 7% gain on a few of these funded accounts and locked in the payout that Friday. So even though it's unrealized P&L on the overall equity curve, if you're following approach 1, which is payout at the end of a month, in this approach, you have the winning period and then you lock in your payout, and maybe your winning period is on 5, 6, 7 accounts. So you can lock in thousands and thousands and thousands of dollars more just by timing these things. Now, of course, you're going to have certain accounts, because it's revolving, are going to be more influenced by the losing periods. Certain accounts, you'll have a losing period, but only 2 or 3 accounts felt that losing period. So there is pros and cons. So you're going to be now doing a full shuffling and a full revolving door strategy where you might have certain accounts that are really up, you lock in the payouts. You have other accounts that are not really going anywhere, so you continue to trade them. You have other accounts that really felt the losing period because of the way you started and stopped the account. The way you revolved that account was just timed, unfortunately, for the losing period, and that's okay. You disregard that account or you keep trading it until it blows, and then you simply pay $500 again and get another $100,000 account and add it into your revolving door system. So it only really cost you $500, but the upside is you can time your winning periods on these few accounts on the revolving door strategy. So you can pull out, even though you only made 1 or 2% gain at the end of 10 weeks, you can actually gain tens of thousands of dollars more in profit through the revolving door strategy simply by timing payouts with your winning periods on certain accounts and disregarding the losing period accounts and just paying for new ones again. So your risk reward would be a few $500 payments to replenish losing accounts. However, you would have made tens of thousands of dollars more and been a break-even trader. So now imagine what happens if you're a profitable trader, where you're overall having a slow growing equity curve with certain periods that have large winning periods and the losing periods are less. Unlike the consolidative one where the losing periods were quite significant, in this one you have losing periods, but they're not -5%, -7%. They're just -1 or 2%, an overall slow gain. So therefore, when you time your payouts, you're going to make a lot more money at the end of a 10-week period than if you just took payouts at the end of each month. You took payouts within on a bi-weekly basis. With the revolving door structure, you can time on certain accounts a lot more payouts because the way you time winning periods with more allocation, and that just comes down to a bit of luck and probability and statistics. But overall, on a long-term period, you will disregard the losing accounts, you will capitalize on the winning accounts, and you don't have full exposure on any of them, and you're just taking regular consistent payouts and having money on the side from your payouts to keep replenishing your $1 million in funding for the accounts that you may blow. Now, where this really becomes powerful is, as you've seen in my public Twitter signals, I have a winning strategy that is slowly, consistently growing. Now, what happens when I have my TP2? When I lock in 6.5% gain in a single session? Because of the revolving door strategy of my accounts, certain ones will have a little bit more losses. I disregard them. Other accounts will have mostly those 1 to 3 risk reward, 1.5% gain trades, and therefore I'll have a decent payout. But then certain accounts are really capitalized on those big TP2 6.5% gain in a single trade. Those will be on certain accounts. So some of my payouts will be normal, some of my payouts will be very large, and other accounts I'll just have to disregard and replenish. And that's just the cost of business. So overall, even though my equity curve at the end of the month might be 7 or 10%, as the average has been over the last 6-7 months, instead of a 70K payout over $1 million, I can get maybe a 100K, 150K because of the revolving door strategy, simply by timing your equity curve more effectively, utilizing your funded accounts. And then you can actually take this a level further, which is when you add dynamic risk, when you add a buffer, when you compound your risk towards max daily drawdown and really go exponential. with a bi-weekly payout system, and that's what you do when you've reached at least $50,000 in payouts. I'll save that strategy for another video. But in this strategy, you start to realize the boring way is simply going month to month and slowly growing an equity curve. That's the reality, the harsh reality of a professional trader on a personal live account. But if you are trading prop firms, it's not your money, there's a reset button, it's not so expensive to buy a new account, and you can get a refund if you make a payout. Well, we should play to their rules, play to the system, get as many allocations on many firms that we can, and play the revolving door game. But the whole strategy only works if you're a profitable trader, and as my favorite saying goes, a restricted trader is a profitable trader.